So just to be clear, like we use Wealthy and Wise with every client. I want to be clear, like just because we're doing the what if calculator does not mean we're not doing Wealthy and Wise. We're doing Wealthy and Wise always, but we do it after this. So the purpose of this meeting, meaning we have a specific meeting for the what if calculator, is to do three things at a high level. Let's be clear, like, because you're right, it doesn't go into all those details. It is one is to kind of look at the current path of savings that they're on at a high level. Two, are they adequately protected against anything that can interrupt their greatest asset, which is their income? So we're checking that they have the right amounts of life insurance, disability insurance, and if they need, which most people do, excess liability insurance. Okay, that's all we're doing with this, and then figuring out the right costs of the right amounts. So I'll share with you what I mean by that, so you can kind of visually see it. So I'm just going to use. Just so you have an idea, we gather data first on our financial data sections. And then from this, we go to our what if calculator, okay? And I'm just gonna clear all this stuff out now so you guys can see me build it from scratch. So let's assume for a second that the person we're talking about is, let's just look at a study period of 50 years, right? And we do an after-tax rate of return, after taxes, after fees of 5%.
Sorry, Ricardo, are you showing your screen?
Oh, I'm probably not, huh?
Yeah, no.
That's probably why you're like, what is he talking about? All right.
Thank you. That's great. Yes.
All right. So we're gonna look at a study period of 50 years for this couple, okay? 25 years working, 25 years into retirement, with an average rate of return of 5% over that 50-year period, assuming minus taxes, minus fees, okay? Now, I'm going to do this very simple just so that you can kind of visually see what you do. So the first thing we're going to put in here is what we call old money, right? So the balance on their account. So let's say 401k, him, right? He's got $150,000, okay? Oops, that's $1 million. And then we're going to add another data point, and 401k her, she's got $400,000. Okay.
Yep.
All right. At this point, we explain to the clients. Oh, excuse me. At this point, we explain to the clients. We click on both of these and say, okay, just so that you know what you're looking at and how the calculator works, because we always think it's important that the client understand this. Is that your 400 plus 150, so they're $450,000 growing at 5% over the next 50 years would grow up to $6 million if you made no contributions, so you did nothing else, right? Now, the next thing we add is his income. And let's say he makes $100,000, but we always do after tax, 30% tax, so $70,000, okay?
Yep.
He's going to work 25 more years, so year 1 to 25, inflation of 3% or 2%, whatever you use. Then we have her income. Again, let's say she makes $100,000 net, okay? Again, working 25 years, inflation 3%. So all of their assets together, we're going to have, for the next 55 years, $45 million if you saved every dollar you made and every cent grew at 5%. Over the next 25 years, though, which is the realistic part, is that of you working, you're going to have $13 million flow through your balance sheet. And this is why we tell clients that our income is our greatest asset. But this isn't realistic, Mr. Client, because we're not accounting for what, right? And it's called lifestyle.
Yes, exactly. Yeah.
Lifestyle. So every dollar that we are not saving, we're spending. So let's say that this couple has $170,000 of income coming in, and they're saving, let's just make up a number, $30,000, right? So that means that they're spending $140,000, right?
Mm-hmm.
That $140,000 is lifestyle that doesn't stop at retirement, right? You still got to eat, you still got to pay for the cars, you got to do all these things. So it goes to 50, and it's still a gallon of milk doesn't cost the same today as it will in 30 years. It didn't cost the same as in the 80s, so 3% inflation. Right? So this, Mr. Client, is the current path of savings that you're on at a high level, right? I haven't gotten into the fee structures. I haven't gotten into the RORs. I haven't, nothing. This is just the current path of savings, which tells me that you're going to run out of money 40 years from now or 15 years of retirement. The good news is that we have time to fix this by other strategies that we can implement. And that's, by the way, that's where we do wealthy
And they run out of money at age 90, right?
Well, no,
Is
not
it
age
50
90.
right now?
because
Year
it's
40.
in 40 years from today. So I haven't,
Yeah,
we
but
haven't
they're
touched-
50. How old are they today, though?
let's call them 35.
Oh, I'm sorry. I thought I saw age 50 on the above. I'm sorry.
Oh, it probably is. I'm just using a sample client just so that
Yeah,
you,
he's
because
running.
they're
at
working
50,
25 years. So let's call it they're 40.
right?
Okay, so even though hang on a second, Ricardo. So even though you put in that they're age 50 currently,
No,
you're
that's
looking
not, that's
back.
the study period.
Oh, that's the study period. I'm sorry. I
age.
thought that was the
Yeah.
age.
So you can do either age or year. I always do years, study periods.
Okay,
years,
that
not
helps
age.
me. I missed that. Okay,
Yeah,
so
you can do it both ways. So,
okay.
yeah.
So as of today, doesn't matter what age they are in a sense, 25 years from today, if they're on that path,
They'll have
they're
$3.8
gonna
million.
be, so if they're 30, they're hurting if they're gonna be 70 and out of money. I got you. All right.
Got it, right? But they're on pace to have saved $4 million. The reality though is that time value of money, $4 million is not worth the same today as it is then, correct?
Got you. Yep.
So based on inflation, everything like that, it says that you have the probability of running out of money 15 years into retirement.
Yep.
Right? The good thing is that we can make changes, look at tax consequences that we can take care of today so that, we alleviate tax, we have better growth, we lower fees, all that stuff. Well, so this is the first out of the three things that we're going to do. This is the current path. Good news, we can fix this. But what we can't fix is the permanent loss of income. So right now, Mr. Client, you each have, Mr. and Mrs. Client, you each have life insurance, right?
Yep.
Of $500,000, right? For both of you, like you each have $500,000, right? So what we're going to do is now we're going to test that this is the right amount of life insurance, right?
Yep.
So we'll show comparison, right? This is the current path that we're on, right?
Yep.
3.8 million. Now let's pretend, Mr. Client, you pass away first.
Yep.
Right? Your income goes away. You're the blue line, right? Your family, your kids, right? You guys run out of money. You never have the same wealth that you do today. But you have $500,000 of life insurance that comes in. That's your family's path now. So instead of $3.8 million, $841,000. Okay.
Okay. Wait. With the life insurance, is they're better off or less better off?
Less better off, right? Like if they're alive, look, it's not the right amount of life insurance. Is what we're trying to get at.
I was going to say it's not the right amount. Yeah, because it's not really doing much.
It doesn't do much, right? Like,
yeah.
And if it's the wife that passes, right? So this is what they look like. He doesn't even get there, right?
Even worse, yeah.
Or worse. So what we're trying to determine now is what is the right amount. So we add additional life insurance. Let's say $1 million, right? And we click in here, right? Better, not the right amount for at least for the wife. 2. Probably it's another $500,000. And by the way, I usually prep for this, so like I know what the numbers are, right? But there it is. So she needs another $1.5 million in order to fix or protect her income if something were to happen today. And for him, it's probably like $1 million, right? There it is. That's for him, her. And we do the same thing for disability, guys. So like, that's how we use it.
Yeah.
And then the only other question is, what is the right cost, right? How much of this 70,000, or let's say that their gross is he's 100 and she's at 125. what percentage of your income are you going to use to allocate to this? So 1%, 2%, whatever. And then that's what they spend. And that's it. Like, that's really what we use this for. We also add, depending on the client, we ask like lawsuit, right?
Liability.
Yeah, like a lawsuit. Like if they got.
Well, let
sued-
me ask you a question too.
Sure.
So let's go back to their 401ks for a second.
Okay.
Assuming they're say 35, 30, 35 years old, whatever, maybe 40.
Yeah.
When it says amount, you're growing that 400,000 and here you got it at 0%. So you're not growing that amount. Those
No, it's growing.
those
It's growing at
401ks.
5%.
Oh, right there, the overall rate of return on.
Yep. Yeah, because if you put 3% increase, it's the 3% increase.
Oh, okay. So you have all their assets earning at an extra 5%.
Right. And the delta between the 170 and the 140, that 30 is growing to 5% too.
Now, what about contribution?
That's a contribution. So they're saving $30,000 in this case, right?
Oh, so that
making-
$30,000 they're saving there. It's either being it's that you're saying that's going towards the 401k plans.
Right. So in this assumption, we're saying that they're all going to the 401k. I
Okay.
understand that there's taxation and fees and all of that. This is not that type of, that's where we're.
They're not putting in a savings account. You're assuming the 30
Correct.
grand's going in at 5% of those 401ks.
Correct. When they have $170,000, right? And they're saving money that is non-savings account, like they have to have an ROR on it, right? So like if they're saving 10 grand a year into their checking account, I'm not putting that in this because the checking account doesn't grow at 5%. So that's
Absolutely.
stocks, bonds, stocks, mutual funds, 401ks, IRAs, Roths.
In this case, okay. And then on their 140,000 being spent every year, we're assuming they're paying their mortgage, they're paying their car payments, they're eating, they're paying taxes, they're
correct,
property tax, all that stuff, right?
all that stuff. Every dollar that's not saved.
So Ricardo, how do you account for the life insurance premium?
So I just add to it, right? So I just say premium, right?
Okay.
Of new life insurance, right?
Okay.
And then let's say they need it for 20 years because the kids are like 6, right? So let's say that the premium it's I don't know, let's just make up a number, $2,000 a year, right? From 1 year for the next 20 years. Got it? And this is money going out.
So this is a term insurance then.
Oh yeah, we're not talking about whole life yet. We don't
Gotcha.
talk about whole life here.
Okay.
Yeah.
Right. So it's just term insurance.
Yeah.
Right. So we just add this. Right. So we're going to take this out for a second. So with the term insurance premium, there you go. Just make sure we got everything right. $2,000 a year.
You need to add in the death benefit, don't you?
No, I don't add the death benefit because this is everything. So like, look, let's go back real quick. So if the path that they're on is to make $3.8 million, right?
Mhm.
Almost 3.9. If something happens to his income, this is the catastrophe that happened. They lose basically $3 million if he dies, correct? Of wealth.
Yes.
But to protect this $3 million of wealth, that's a difference. There's a cost to it, which is with a term insurance premium, correct?
Yep.
So the term insurance premium is only $2,000. So when you click on it, that gets reduced 3.808 instead of the almost 9. So it's costing them about $80,000, right?
Yep.
To protect. But you see the delta on it. Like, what would you rather have? Not spend it, and if you need it, you're out $3 million, or just lose 90,000 and still have 100% of the time you're 3.8 million.
Right. Gotcha.
Does that make sense, guys? Like,
Yeah, I see what you're trying to do. You're obviously trying to bridge that gap with additional life insurance, and you got to obviously be able to prove they can afford to pay the $2,000 premium or whatever. I mean, in this scenario, they obviously have the extra cash to do it. And when you get someone to this point, your advisor is going to move them towards a term policy, or you might talk about whole life with them and that kind of thing.
not here.
Not yet. Okay.
Not yet. So this is just, the purpose of this is just the current path that they're on, the right
Yep.
amount of protections, both for term insurance, disability insurance, and excess liability and umbrella insurance.
Gotcha.
That's it.
Gotcha.
You
Right.
are basically identifying the risk.
Correct. We're identifying risk and how to fix it.
Okay.
That's it.
It almost should be called the risk calculator.
Yeah. Well, I didn't
Yeah.
get to name it. I didn't get to name this.
What if is pretty good, and then what if something happened to your
Yeah.
income? You get
That's what it's for, right? It's like
Yeah.
the what if. Like we used to call it at our old firm like the life events,
Yeah, yeah.
Yeah.
right? But it's the what if, right? Like what if you pass? What if your income? Like what is all this stuff, right?
Mhm.
And then guys, like I do an investment conversation with my clients that is just a whiteboard conversation on how we're going to invest. And then we go right into wealthy and wise. And then that's when we do, like, let's say in this case, these guys were each putting $15,000 of money into their 401ks. So 30 grand altogether, but they only had a match of like 5 grand each. Then I would show them how to, if instead of the current path that they're doing, saving $30,000 plus the 10 grand that they get, right? Which is 40,000. If we allocated 80% of, up to the match, then the rest in a brokerage account, and then maybe cut off 20% of that and to put that into whole life,
Mhm.
how that looks and how that compares, then
Yeah, that's an interesting play as well. Yeah, I like that. Yeah.
So this is the extent of the what if calculators use for
yes,
most of your
that's it.
clients. Okay.
Yeah. We don't ever talk about whole life here. We don't ever talk about like the investment, like in a deep dive. That's in the next meeting where we analyze like taxation of the investments, taxation of the accounts, and things like that.
That's when you are using Wealthy and Wise
Yes. Well,
or something else.
yes, we are always using Wealthy and Wise, but depending on the investment level of the client and the accounts that they have, we do an investment like review, meaning we run reports on their current 401k allocations to see if they're on the efficient frontier. We do reports to make sure like the taxation on the accounts if we need to, and then just fee structures and things like that.
Okay. Could a common proposed plan or one component of it be an annuity product?
Yeah, it could be. So it depends, right? So me personally, most of my clients, like I'm 45, so like most of my clients are around my age. So I don't have a lot of use for annuities. I do a lot of managed money. But every once in a while, I have like a 60-year-old or 55-year-old. Yeah, I use annuities and I can illustrate them in Wealthy and Wise.
Mm-hmm.
They're great.
Okay.
Wealthy and Wise is great.
Okay. So yeah, this makes a lot of sense. And so it's giving me a lot of better understanding of what this calculator is used for.